Hi everyone, welcome to Chapter 8. We will be discussing a lot about costs, how producers organize all of their resources, the costs of producers, and how this impacts their decision of how much to produce. So we're doing a lot of graphing, some math with it. Chapter 8, Cost and Producer Supply. So let's talk about business firms. A business firm is basically any entity that will organize raw materials, labor, machines, things of this nature. So if you're a pizza place, let's just say that you own a pizza place on Hodges. So you are going to purchase tables, a pizza oven, tomato sauce. You're going to hire labor. You're going to organize all of these resources, bring them together, and then produce a product. And then you're also going to have to decide how to sell that product. What prices, what types of pizza, what is your market niche. So as a producer, really you're in charge of everything for the most part. And in a market economy, basically we have residual claimants. Usually we have the owner of the business, and the owner of the business gets to keep the profits. This results in sort of an invisible hand where this producer will probably produce for the least possible cost. They get to be the residual claimants so that if they do a great job and produce products, if they do a great job and get to get $1 million and get to be world famous, well, it's up to them to do it for the most part. It provides a very strong incentive to organize, structure the business in a manner that will keep costs of producing low. There's 3 types of basic business firms. There's more, but we're going to focus on 3 basic types. One is a proprietorship, a business firm owned by a single individual who is fully liable for the debts of the firm. This represents about 72% of all businesses, but it only represents about 4% of all business revenues. The result is that we have many, many, many small businesses. These might be barbershops, grocery stores, family-owned restaurants, things of that nature. The other type is a partnership, which consists of 2 or more people who are co-owners of a business. They share the liabilities of this. So it represents not 72%, but only 8% of all businesses in the United States. But it accounts for even more revenues, about 12%. So these tend to be a little bit larger. They might be lawyers, accountants, financial firms. They get together and they form partnerships. The next type of firm is a corporation, and this is probably more of what we're used to thinking about when we talk about firms. But the business firm is owned by shareholders who possess ownership rights. So that could be the family. It could be a privately held corporation where shareholders are a family, or it could be a publicly held and publicly traded where you and I would get to invest in the business as well. The nice thing about a corporation, it's really huge. It really limits your liability. So your only liability, if you're a corporation, is the amount of your investment. So let's just say a corporation does something really horrible. They can't go after the investors. You can only go after what the investors have invested initially, not necessarily the true damage that the corporation is perceived to have caused. It is 20% of all businesses in the United States, but it accounts for 84% of all revenue. So these tend to be the large corporations, Walmart, Target, Dell, other sort of building corporations in general. All right, so let's talk about costs a little bit. So the demand for a product represents the voice of consumers. So I love fat-free frozen yogurt. Demand for fat-free frozen yogurt has gone up dramatically, and what do we see? We see so many new fat-free frozen yogurt shops popping up everywhere. It's because they know they can sell it, and they can sell a quart for $12, except on Mondays. You go to Yoga-Berry, it's only $6 for a quart. Still, highway robbery almost. So production of these goods requires resources. A firm's costs represent the opportunity cost of these resources. So let's just say, what is the cost of a resource? A cost of a resource is, to an economist, something very different than, say, the purchase price. The cost of a resource is what you can sell it for. What other people think that it's worth, that's the cost, according to an economist. So let's just say you went to the Olympics in Rio this last year, and it's a great event. You got a great tickets, family of 4. What is the cost of those tickets? Well, the cost of the tickets could be, one, the amount that you paid for them, right? Maybe you got them for a great price, $30 a piece. But if it's a great event, somebody's probably willing to pay you $100 per ticket. So what is the cost? Is the cost the $20 that you paid, or the value of those tickets to someone else? What are you giving up in order to go to the Olympics? You're basically giving up the amount that you could sell it for. So this is kind of the opportunity cost, and this is what distinguishes economists from, say, accountants. Knowing the real cost, the opportunity cost, helps us predict people's behavior, right? If a person perceived that the cost was just what they could get for the ticket is $20, what they paid for it, compared to $100 if they could sell it. All right, so basically we're going to have some definitions and a lot of equations in this chapter. The first one is profit. Profit is going to be equal to total revenues minus the total cost. So if you own the pizza place, it's all of the revenues that you take in minus the costs that you have to pay out. So in economics, we're going to define something called implicit and explicit costs, because total cost comprises both explicit and implicit, the real cost of the resources. So explicit costs result when monetary payment is made. For instance, let's just say you're running this pizza place and you have to write a check for the rent. You have to write a check to the waitresses. You have to write a check to the people who deliver your toppings and other supplies. So those are explicit costs. But economists want to consider the cost of a business to be inclusive of the implicit costs as well. So an implicit cost is maybe something that the owner has given the business for free. Let's just say the owner devotes his time for free. He doesn't necessarily get paid except out of profits. Well, the value of his time is very important, and that is an actual cost of running the business. He may not write a check to himself, but it's definitely a cost of running this business. He's giving up his time when he could be doing something else. Likewise, what are other examples of foregone alternatives? One is your wage, like if you give your labor for free to the business. Another one might be, I'm going to take some money out of my 401k to start the business, or I'm going to take money out of my bank account to start the business. Well, I'm giving up a rate of return. If I take $10,000 and devote it to my business, I can't be earning a rate of return on that in the bank. So that is also a cost of doing business. It's not explicit because we don't absolutely write a check for it, but it's absolutely an implicit cost because it is a cost of doing business. You are foregoing the rate of interest that you could be earning in the bank. So it is a cost of doing this business, but economists call it an implicit cost. So basically what we've got going on is that accounting profit versus economic profit. So accounting profit is total revenues minus explicit costs. And economic profit is total revenue minus explicit cost minus implicit costs. So which is greater? Is economic profit generally greater or accounting profit? Yes, accounting profit will be higher. Basically what we're going to do is with accounting profit, we do total revenues minus explicit costs, and then we might have some extra profit, right? So we might have some extra profit. What do we do with that? We give it to the shareholders in retained earnings or as dividends or something, or you pay yourself your wages as a result of it. So accounting profit, basically what you use that profit for is to pay your investors. With economic profit, the investment costs are already included here. we already have to account for the fact that we need to give this owner of the implicit resources a rate of return. But definitely accounting profit will always be greater than economic profit. So economic profit will be positive only if total revenues exceed all the costs of running the business. So you have to compensate the owner for his time. You have to compensate the owner for the value of the investment that he took out from the bank. So we are valuing all of the resources at the rate at which they could be paid in other uses. So basically, for an economist, we usually expect zero economic profit. We usually expect that in a very competitive industry, you are going to be making just as much as you could make elsewhere. In a very competitive industry, you could make just as much as you could make elsewhere, and that means that you have zero economic profit. You are giving a return to all of the resources, both explicit and implicit. Does that kind of make sense? So zero economic return is very typical. All right. Let me get rid of that. I don't want to make that small. All right, so let's take a look at accounting versus economic profit. So here we have a grocery store. And in this grocery store, basically what we've got is we've got total revenue of $170,000. They're selling groceries, they're earning $170,000. And so some of their explicit costs are things that you write a check for, right? That you're going to write a check for every month. That might be groceries, utilities, taxes, advertising, labor, things of that nature. So the total explicit cost, it looks like their accounting profit is $70,000. Wow, not bad. Accounting profit of $70,000 looks good to me. But what we haven't accounted for in the explicit cost are implicit costs, things like the interest. So basically, we have to give a rate of return on this owner's personal investment. The rent, because the owner donated his building and he could have been renting it out for other purposes up to $18,000. So that is a cost of running this business. The fact that he's not earning $18,000 elsewhere. Likewise, his salary. So his total implicit costs are $75,000. So if we look at accounting profit, it's negative $5,000. He's not getting a good rate of return for all of the things that he has invested himself. Should he continue to run this grocery, or would he be better off closing it and redirecting these resources back to their original uses? Yeah. So accounting profit said that he should stay in business. But economic profit, by looking at all of the total costs, we're better able to predict his behavior. We predict this guy is probably going to go out of business unless he starts to earn more money. Make sense? The implicit costs were very useful for determining behavior, predicting behavior. All right, so let's take a look at this. This is kind of a clicker question, kind of tricky. So I like to do it as a part of class. A Ford Exchange student bought a used car for $10,000 and resold it 1 year later for $6,500. We're going to try and calculate the cost of owning this car. So he bought it for $10,000 and he sold it a year later for $6,500. What that means is a cost of owning that car was the fact that it was worth less after a year. That is, that you use the car a lot and now it's worth less. Insurance, license, and operating costs for the year were $1,500. So here, that's also a cost of owning the car. Another cost of owning the car is $1,500 in operating expenses. What was the economic cost of owning and operating the car for the year if the market rate of interest was 10%? So he could have been earning 10% on this $10,000. Had he not bought the car, he could have been earning $1,000 in foregone interest. So looking at all of these aspects, the total cost of owning the car for this year is $6,000. 35 plus 15 plus 1,000. Make sense? I hope so. All right. So let's talk about short run and long run, because we're going to be trying to predict firm behavior in both the short run and the long run. So short run, again, this is different for an economist compared to anybody else. Short run and long run is different. For an economist, a short run is a period of time so short that the firm's level of plant and heavy equipment is fixed. So for the firm, let's just say you own the pizza joint. Well, the short run, I can increase production by getting more waitresses. I can increase production by selling more pizzas and getting more dough and things of that nature. But in the short run, I cannot increase production by expanding facilities and opening a new store. The level of plant and equipment is fixed. So I can expand and sell more pizzas, but only within the same capital structure. In order to expand output, I have to do more of the variable inputs. All right. So in the short run, output can be altered by changing the usage of variable resources, not fixed resources, not plant and equipment. The time duration of the short run will differ across industries. So, for instance, the short run versus long run, we'll talk about that in a second. Let's talk about the long run. The long run, in contrast, is not like the short run. The long run is a period of time sufficient for the firm to alter all factors of production. So it can alter plant and equipment. It can buy a new pizza oven. We can open a new spot on Hodges. We can expand stores and stuff like that. So the long run is the amount of time that it takes to expand all of it, including plant and equipment. And again, the time duration of the long run will differ across industries. So, for example, what if I want to expand electric production in Jacksonville, electricity production? Well, in the long run, how long is it going to take to build a new plant and equipment? In the long run for electricity is probably 10 years. All of the regulations that are involved, it's going to take forever to expand plant and equipment in the long run. How about if you own a lemonade stand? If you own a lemonade stand, you can expand production selling more lemonade with more freeze-dried lemonade, or you can build a new stall, a brand new kiosk for selling lemonade. So how long will that take to expand production? Well, if you got like a handyman person around or a handy gal person around, it could take as short as 2 days to build a new kiosk. So my point is, what's the point here? Is that the long run differs depending upon the industry. For a lemonade stand versus the electricity, it's going to be a totally different time period. So the idea here is that it could be different for every industry. Okay, how about this one? Short run is a time period such that yes, the answer is C. The existing firms in the market do not have sufficient time to increase size of their existing plant or build a new factory. How about long run? Yep, that would be C. All right, so cost in the short run. All right, so this is such an annoying chapter. It's a bit of an annoying chapter. You really have to focus on these graphs. And there's different characteristics for the short run and the long run. So I will be really emphasizing this is a short run, this is a long run. Almost all of your questions on this chapter will be related either to a long run or a short run scenario. And so the answer will depend upon whether it's a short run or the long run. And a lot of time in these multiple choice questions, they're going to say, it's the short run, or, oh, enough time for the market to adjust. That's another word for long run. So every multiple choice question will probably be leading you to either a short run or a long run scenario. So let's pay attention to that. Remember, short run, you have fixed resources. In the long run, all resources are variable. All right, so let's talk about short run. We're in the short run costs. So this is a short run. We can't expand plant and equipment. We can only increase production or decrease production by varying variable inputs, such as the number of waitresses, the amount of dough, things of that nature. All right, so we have fixed costs. All right, so fixed costs are things like insurance premiums, property taxes, things of that nature. So basically, the big thing about fixed costs that you should really take note of is that fixed costs do not vary with output. Whether you sell 0 pizzas on Sunday, let's just say you close on Sundays. You sell 0 pizzas on Sunday. You're right here. Why do you have total fixed costs that are positive? Well, you still have to pay rent. You still have to pay insurance premiums or property taxes. Whether you sell 1 unit of output, 0 units of output, or 100 units of output, these costs are the same. Make sense? These are fixed costs. We have to pay them no matter what, whether we produce that day or not. Very important. So there's my fixed cost, and I'm going to define something called average fixed cost. So we have these fixed costs like rent and insurance, and what we're going to do is we're going to spread them over more and more and more units. So the cost per unit, the fixed cost per unit, another way of saying average fixed cost is to also say fixed cost per unit. A lot of multiple choice questions call it that, so make sure you understand that when they say fixed cost per unit, they're talking about average fixed cost. Got it? So average fixed cost declines as output expands. So we're going to spread these fixed costs over more and more and more and more units. Here, we're going to be spreading these fixed costs over very many units. So the cost per unit goes down. Got it? So here we can calculate it, kind of like this. This is kind of cool. All right, so we have 0 output per day. At 1 unit of output, fixed costs are 50. At 2 units of output, average fixed costs are 25. At 4 units of output, average fixed costs are 12.5. And so they just decline exponentially, basically. All right, now we're going to talk about variable costs. You remember fixed costs. Fixed costs were the same no matter how much we produce. We can shut down on Sundays, we still have to pay fixed costs. The amount that we pay is not determined by the amount of quantity that we produce. Variable costs are different. Total variable costs, the only reason why total variable costs rise is because we're producing more output. Variable inputs, in order to produce more pizzas, we're going to have to use more toppings, more waitresses, more cooks. In order to produce output, we're going to be utilizing more intensively these inputs. So payment for raw materials goes up, cost of labor goes up, things of this nature. So if my output is 0, do I use any of these variable inputs? What about on Sundays when I close? I'm a good Catholic pizza person, so I close on Sundays. So when I close on Sundays, I have 0 output, and I also have 0 variable costs. This is very different than fixed costs. Remember, I had 0 output, and I had positive fixed costs. Now I have 0 output, and I have 0 variable costs. So these are the variable costs. They're always positive, but not if the firm is shut down. If the firm is shut down, then output is 0, variable costs are 0. So we're going to define total cost as equal to fixed plus variable. Your total costs are going to be fixed plus variable. Total cost is positive, and it increases with output because your variable costs increase. As you expand more output, then you've got to use more variable inputs. And then we have average total cost. So notice total cost is equal to fixed plus variable. And now what we've got is average total is equal to average fixed plus average variable. Average total is equal to average fixed plus average variable. So we've kind of got two different equations at this point. All right, so let's kind of take a look at this. We have fixed cost plus variable cost. So what's total cost? How do we get 6,000 here? How do we get 6,000 as total cost? Yeah, fixed plus variable is total. 4 plus 2 is 6. All right, average fixed cost. How do we get that? How do we get that? Average fixed cost, how is that equal to 40? Yeah, 4 fixed cost divided by the amount of output. 4,000 divided by 100. Average fixed cost per unit. Average variable cost is 20. Average total. So notice average fixed plus average variable is equal to average total. Just like fixed plus variable is equal to total cost, average fixed plus average variable is equal to average total. Good? All right. So we kind of get how these equations are related. We're also going to talk about something that's marginal cost, which is the change in total cost divided by the change in quantity. So here we're going from 60 to 35, nope, 6,000 to 7,000. The change in total cost, marginal cost is going to be defined as the change in total cost divided by change in output. So change in total cost is 1,000, change in output is 100, so that's why that's marginal. From here, change in total cost is 500 divided by 100 is 5. So we get this marginal cost, change in total cost divided by change in output. All right. So here it is numerically, right? We have all of these relationships with variable and fixed costs in the short run. These are all short run concepts. And so we have it numerically here. And now we can show it graphically. We have average total cost is going to be U-shaped. We're going to see this in a minute. Average variable cost is going to be U-shaped. We have marginal cost and then average fixed. So do you notice that? All right, I just want to point some of these things out because there's so many multiple choice questions that are kind of tricky. And so I'm going to try and point out some of these key points. So notice that average fixed plus average variable is equal to average total. So this plus this is equal to this. 8 plus 14 is equal to 22, right? So we see this numerically, but look, we also see it graphically because the difference between, say, maybe I should do this, picture tools. Let me see if I can do this here. Let's look at pens. And so notice that the difference between here and here is the same as the difference between here and here. Because average fixed plus average total is equal to average variable is equal to average total. So this difference is the same as this difference because what is the difference between this and this? What's the difference between average total and average variable? Yes. Do you see how we can add these up too? How this adds up? So these differences are the same graphically too. So a lot of times what they're going to say is they're going to say, well, if we have this number here and we have this number here, what is the amount of average fixed cost when output is 100? Right? So you just look at this difference and then you know that that's average fixed. So you've got to be able to do this addition and subtraction both with numbers, right? 7 plus 17 is equal to 23. But you also need to be able to do that here. This plus this is going to be equal to this. So we can see this relationship graphically too. All right, let's keep on. We got to keep going here. All right, shape of the average total cost curve. We have a U-shaped average total cost curve. Let's take a look at this. We do indeed have a U-shaped average total cost curve. It goes down for a while and then it starts to go up for a while. It's U-shaped goes down as output increases, and then it starts to increase. And indeed, we do see that it goes down for a while and then it starts to increase. Basically, average total cost is high for underutilized plant because we have really high fixed cost here. But as we expand our output, then marginal cost starts to go up, and so our average total is going to start to go up. So there's your U-shaped of your average total cost curve. Average variable cost is going to be U-shaped, and average fixed, of course, is going to be all the time declining for the most part. All right, marginal cost, again, is the change in total cost divided by the change in quantity. The change in total cost divided by the change in quantity. So here's the change in total cost is 15. The change in quantity is 1, so marginal cost is 15. Here, change in total cost goes from 84 to 92. Change in total cost divided by change in quantity is 8. We can also see this up here. Let's just go back and look at this one more time. We have a change in total cost, say going from 7,500 to 9,000, right? And that's 1,500 divided by 100 is $15. Does everybody see how we got this number? It goes from 75 to 9,000, so it increased by 15. Output increased by, 1,500 divided by 100 would be $15. Make sense, you guys? So that's how we're going to calculate marginal cost. All right. Okay. There's my marginal cost. It's U-shaped. It goes down for a while and then up. All right. So let's talk about this first. We have these formulas. So this is basically what we've learned so far. We've learned has everything to do with total cost is equal to variable plus fixed in the short run. We have fixed cost, but only in the short run. So variable plus fixed is total, and then we have average total is going to be equal to average variable plus average fixed, and we need to see this both graphically and numerically, kind of like what we've done so far. The other thing to recognize is when we're drawing these graphs, so important. What we're going to realize is that, SpaghettiOs. I'm going to get rid of this stuff. All right, so what you want to realize here is that we have average variable declining for a while and then average variable increases. What you have to be cognizant of is the fact that this marginal cost intersects at the minimum point of average variable. Likewise, marginal cost intersects at the minimum point of your average total. This is the minimum point of average total, and marginal cost is going to cross there. Likewise, the minimum point of average variable is right here, and marginal cost will always cross there. You have to know this. This is the most important thing about these cost curves. You're going to get so many questions on it. The marginal cost intersects at the minimum point. I can show that to you, and it will always be true. All right, so let's look at this average variable cost and average total cost. So does marginal cost intersect average total at the minimum? So average total is decreasing, 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 increasing. So it's got to be here. This is the minimum point. Is that where marginal cost intersects? Does everybody see that this is the minimum point of average total cost? You guys all agree? Indeed, it's $22. It's the minimum point of average total cost. Where does marginal cost intersect? Here, marginal is below. It's a little bit below, but here it's above. So marginal cost has to cross somewhere in here, in this little area. Make sense? Here it's below, here it's above. Marginal cost is above here, and it's below here. So it would intersect at 500, the minimum point. It's always going to work that way, you guys, okay? And then, so you always have to know that it's going to intersect here and here. All right. Typical question. All right, let's just say that your average is rising. Here, your average is rising. The marginal must be above. The marginal must be above if the average is rising because it hits at the minimum. Here, this starts to go up, right? Average total starts to increase. Marginal is above. Marginal is above when it starts to rise. When it's falling, when average total is falling, marginal is below. All right, so let's kind of think about why this might happen. Let's just say the class average on the last test was 85. It was about 85 on the last test. It's pretty good. You guys are doing well. All right, so let's just say the class average was 85 on the last test. And then we had a new student come in. And that new student made 100. What would that do to the average? Before that student came in, before that marginal student was added to the group, the average was 85. That marginal student had a grade that was 90. What's going to happen to the average? The average will rise. So that's the idea here, you guys, is that if the marginal score, if the marginal one is above the average, if the marginal is above the average is rising. If the marginal score is below the average is falling. Likewise for average variable cost, same thing. Hits at the minimum point. All right, so which of the following must be true if average total costs are declining? A is the right answer. Marginal cost is less than average total. Right. Marginal is less than average total if average total is declining. Not true for here. Here, this is still declining, but that's rising. That has nothing to do with average variable. All right, so you guys got that? That this is a way we have to draw the cost curves for the short run. Your average fixed is always declining. You're going to do a U-shaped average total with a U-shaped average variable. The difference between these is going to be the average fixed, and it's always going to hit at a minimum. It's always going to hit at the minimum of average variable and average total. You got that? You got pretty much the shape of the cost curves. You're going to do fine. All right, use this question to answer the following question. We got total fixed cost, total variable. What's the average total at an output level of 4? It would be equal to average total. So we got total costs of 6,000, don't we? Divided by 4. Total cost divided by quantity, that would be equal to 1,500. Make sense? Let's look at this one. If fixed costs are 200,000 and variable costs are 30 per unit, what does that mean? 30 per unit. That means that your average variable costs are 30. Make sense? Anytime a multiple choice question is going to say variable cost per unit, what they're saying is average variable cost. So fixed costs are 200,000, variable costs are 30 per unit when there's 10,000 units produced. So we've got fixed costs of 200,000. That means average fixed costs are 20. So average total costs, which is what we're looking for, will be equal to 20 plus 30. We got the 30 out of here. Average variable plus average fixed is equal to average total. So the answer would be 50. You're going to get a lot of those. All right, let's carry on. All right, so we've got our short run cost curves, and now we have another short run element, and it's the law of diminishing returns. We have the law of diminishing returns only in the short run. Again, you want to keep straight what is a short run and what is a long run concept. So the law of diminishing returns, so let's just say we're the pizza owner, and we have fixed capital stock. We have fixed amount of pizza ovens. We've got a fixed amount of store that we can pack all of our tables into. So our restaurant and ovens, they're fixed. It's fixed in the short run. So the law of diminishing returns says that as more and more units of the variable factor are applied to a fixed amount of other resources like plant and equipment, output will eventually increase by smaller and smaller amounts. That is, as you apply a single resource more intensively with fixed capital stock, the resource will eventually accomplish less and less. Let's just say we put on a handful of fertilizer. That grass will go crazy. If you put on 3 big cups of fertilizer, it's not going to grow 3 times as great. The additional amount that it will grow becomes less and less. Another example that I always use is of diminishing marginal returns. Let's just say we hire more and more workers at McDonald's or even our pizza place. So we have this fixed pizza oven, whatever. So we hire more cooks. We hire more waitresses. We get more variable inputs like tomatoes and dough and toppings and all of that. So we keep adding more and more waitresses, more and more toppings, but eventually the amount of pizzas that we can produce diminishes because of fixed capital stock. Sure, the first waitress can sell more, the first cook, the second cook, maybe even the third cook, but after 12 cooks, you can add another unit of labor and you can't get any more pizzas. The additional output that we get basically becomes less and less as we add more variable inputs like labor and tomatoes and stuff like that. And it's basically congestion of capital. It's a short run. You have a fixed capital, you have a fixed amount of pizzas and that you can utilize. You can only add so much more and get more output because you're constrained by your capital. It's congestion of capital that causes diminishing marginal product in the short run. It is congestion of capital. That is, capital gets overloaded. The pizza oven gets overloaded and you just can't produce that much more. This is the idea of diminishing returns in the short run. Once diminishing returns are reached, it will take successively larger amounts of variable factors to expand output by 1 unit. That's another way of saying the same thing. But it's another way that they can trick you in a multiple choice question, so pay attention to it. So we've got total product, marginal product, and average product curve. So basically what we've got going on here is this is your output. This is a different graph with different axes. This is the amount of variable input. Here we're adding more and more labor to a fixed capital stock. Here we're adding more and more labor. The first unit, pretty good. Or the units of variable resource. We're going to add 2 units. We're going to get 20. We add 4, we get 46. We add 6, we get 64. We add 8 laborers, we can sell an additional 10 pizzas. We add even 2 more and then it gets way overcrowded and starts bumping into each other and you're going to sell even less with more variable inputs. Here we're going up from 8 to 10. Let's say workers, we're adding 2 more workers and we can sell even less because it's getting so crowded in there. So the idea here is that we have diminishing marginal product. The additional output that we can get from 2 more laborers is 10. The additional output we can get from 2 more laborers is 13. It goes 26 divided by 2. The additional output is, it's starting to diminish. It's starting to get less. It's 9, and then it's 5, and then it actually gets negative. So we have diminishing marginal product because of congestion of capital. So, your marginal product goes up. In general, this is not a graph that we get a ton of questions on, but you might see this graph in a question. And so what you need to know here about the total product curve and diminishing marginal product. Okay, so really what we're doing here is we're using marginal product to explain the slope of the marginal cost curve. That is, when your marginal product is rising, when you're adding more variable inputs and you're getting a lot more output, when your marginal product is rising, the marginal cost, the cost per unit is falling of producing that. When marginal product rises, marginal cost falls. They're on totally two different graphs, two different axes, but you've got to pay attention to this. This is the kind of the whole point of doing this marginal product stuff, is to relate it to marginal cost. So when my marginal product is rising, my marginal cost is falling. When my marginal product is falling, guess what? When my marginal product is falling, my marginal cost is rising. So we're kind of explaining why is it that marginal cost is going to go up and down. In the short run, my marginal cost goes up and down because of diminishing marginal product. We cannot continually add laborers with a fixed capital stock. Costs are eventually going to go up. So short run cost curves, this is another so common of a multiple choice question. This is kind of the flip side of this graph. Here we have marginal cost falling, don't we? Over these units of output. So that is output. Okay. Let me just change that color. Okay. All right. So we've got output. So output is expanding. Marginal cost is going down for a while. As we start expanding output, my marginal cost is falling. How come? You got to know this. My marginal cost is falling because my marginal product is rising. That's why. Right here, at the minimum, my marginal cost starts to rise. How come? My marginal cost starts to rise because of diminishing marginal productivity in the short run, congestion of capital. You've got to know that, okay? And mostly, this particular book deals with marginal product, mostly as it relates to marginal cost curves. So law of diminishing returns explains why a firm's short-run marginal and average cost curves eventually rise. When returns to variable factors are rising, marginal costs are falling, and eventually will cause average total cost to fall. But when returns to variable factors are falling, marginal costs are rising. When we have diminishing marginal product, marginal costs are rising and eventually cause average total cost to rise. A lot of material. I think you're going to be fine though. All right, let's talk about the long run. So far, all of what we've done so far is all short run. Now we're going to do long run. So in the long run, all costs are variable. You can build as many pizza stores as you want, and it's up to you to decide how many, right? Where is your best profit margin? At 2 stores, 4 stores, 8 stores, how many? So in the long run, all costs are variable. So basically what we're going to have is we're going to have kind of this long run planning curve. All costs are variable. So here we have this plant and equipment. Alternatively, we can build another factory and we can have this plant and equipment. Alternatively, we can build another factory and have this plant and equipment. So all these are kind of short run cost curves, but it's an envelope of the long run average cost curve. If the cost per unit varies according to the size of the facility, then long run average cost curve will be mapped out as a surface of all the minimum points possible of the short run curves. So let's talk about economies of scale. Economies of scale, basically what happens with economies of scale is we can get lower cost per unit. Economies of scale is a long run concept. We never use it in the short run. We're going to have different sizes of plants and equipment. We're going to have lots of different plants or very few plants. And in doing so, we can spread the costs over more and more units. We can spread fixed costs over more and more units. So we get a decreasing per unit cost. So if we can expand output, let's just say, what is the cost per unit for Tesla, who produces, say, 10 cars per year? The cost per unit is really high. Would their costs go down if they could produce 100,000 units per year? Yes, because you could have mass production, you could have specialization, and you could have improvements in production as a result of experience. You're getting better at producing these cars or pizzas or whatever. So the idea here is that if we can produce, we can reduce the per unit cost as output expands, and we get a lower per unit cost. So here, this is the economies of scale. We're expanding output, but the fixed costs are getting spread out of more and more units, mass production, specialization, we're learning, the cost per unit go down. After a while, though, we may get some diseconomies of scale, and we'll talk about that in a minute. Diseconomies of scale, it's an increase in per unit cost as output expands. So basically the idea here is what we think, and we used to think this especially before technology replaced so many middle managers. Back when I was a kid, everybody's dad was a middle manager, right? And then technology came in, and it turns out that we didn't need 12 different middle managers. We could just email and FaceTime and have digital stuff. So we ended up replacing a lot of middle managers. But the idea here is that if you expand too much, that you're not able to focus on your core missions. And so it may be that you have disorganizational economies. You become just too disorganized, trying to produce too huge of an output. And as a result, the cost per unit starts to increase. This is the diseconomies of scale. This is the diseconomies of scale right here. Diseconomies of scale. When your long run average cost curve is increasing, that's diseconomies of scale. If your long run average cost curve is decreasing, that's economies of scale. Again, long run, you guys, long run and short run are totally different. You got to keep them separately. Economies of scale is a long run idea. So what we may have is, you know, everybody's cost curves in the long run are a little bit different. And so here we have economies of scale for a while, then we have constant returns to scale. You can expand output for basically the same prices. And then diseconomies of scale. As we increase output, our cost per unit start to increase. So what's the ideal plant size? Yeah, you want to be the most competitive. You want to be producing at the lowest possible cost in your industry. You certainly don't want to be here because your competitors are going to beat you out. They're going to have much lower cost per unit than you are, and it's not going to last in the long term for you. So basically your ideal plant size is to target somewhere in here. Okay, so there's different types of long run average cost curves. In this case, we have constantly decreasing costs. Constant economies of scale. The more the output you produce, the lower the per unit cost. And this usually happens because of really, really high fixed costs. The ideal plant size is as large as you can get in this case. So what are going to cause cost curves to shift? Same thing that shifts the supply curve. If we have the price of resources go up, if the price of resources go up, let's just say you have to pay more for oil. It goes from $20 a barrel to $85 a barrel. Well, your cost curves are going to shift to the left. Both your average total is going to go up and your marginal cost is going to go up. Average total and marginal are going to go up. So if your cost of resources go up, your costs shift up. If you have taxes, if you get a tax or new regulations that raise the cost of it, such as new regulations such as airbags. You have to have airbags. Well, all your costs are going to shift up. The only time that it's going to shift down is if your cost of resources go down, or maybe you have some new technology and improvements in the way that you're able to produce pizzas, or there's a new way to produce farming products or something like that. In that case, then what you would have is you would have a decrease in cost. So all your costs would be shifting down as opposed to up. But so mainly the types of questions that I've seen always have to do with cost of resources and taxes and regulations for the most part, maybe some technology. But those will all shift the cost curve. So which of the following would most likely cause an upward shift in the firm's cost curve? Yep, C, increase in resource prices. If you have to pay more for any sort of key input, it's going to raise your cost of production. All right, so let's see here. Sunk costs. Sunk costs are historical costs. You can never change them. You can never recover them. No matter what you do, you will never change the amount of sunk costs. So it may provide relevant information at some point in the future, but you should never base your decisions based upon sunk costs. All of your current choices should involve current costs. How about this? What's a sunk cost? I will have to take a cab today because my car broke down. Is that a cost that you should consider? The cost of cab of going to school? Yeah, it's definitely a cost of going to school. How about I paid a lot for tuition at the beginning of the term. Should I go to class today? Should that impact your decision of whether or not to go to class? No. It's a sunk cost. You can never recover tuition. All right. All right, so let's do this example. You already purchased a rollerblade producing machine for $100,000 and it's expected to last about 10 years. The annual production of rollerblades generates about $50,000 in revenue. And annual costs are about $46,000. So if you produce this year, you can never recover the $100,000. And in fact, the $100,000 is kind of a sunk cost because no matter what you do, you can't sell the rollerblade machine. You can't recover that $100,000 at all. It's gone. So the question is, should I produce this year? Let's see, if I produce this year, then I'm earning $50,000. The cost of production are $46,000, so I end up with $4,000. Should I produce or not? Yeah, you should. You should go ahead and produce rollerblades this year and earn $4,000. How much do you get if you produce? $4,000. How much do you get if you don't produce? You just decide to shut down. Well, then you get zero. So that's bad. And you still owe $100,000 no matter what. So the idea is that you would minimize your costs if you ignore the sunk costs and you just look at your current costs and current revenues. How about, should the firm purchase another machine when this one wears out? No, you're just going to end up losing $6,000 a year like you did last time, right? No, do not buy it, not unless you can earn more than $50,000. If you can earn more than $50,000, then that's fine. But if current conditions remain the same, do not buy one in the long run. How about this one? You paid $100 for a truckload of cabbage on Monday. How much should you be willing to sell it for on Friday, the day before it spoils? Is a truckload of cabbage, is that a sunk cost? Yeah, it is a sunk cost. You should be willing to sell it for whatever you can get for it. Whatever you can get for it. The 100 is a sunk cost. So when making output decisions in the short run, is the firm's marginal costs that are the most important. Marginal cost reflects the changes in the variable cost needed to produce more output. Additional units will not be supplied if they do not generate additional revenues that are sufficient to cover marginal costs. So this is basically foreshadowing our next chapter, where we're going to look at if the marginal benefit of that unit is greater than the marginal cost, the firm will continue to produce it. We're going to be looking at that pretty soon. For the long run output decisions, it is the firm's average total costs that are most important. The firm has to be covering its average total costs in the long run. If not, it's going to go out of business. All right, so that's it. Nice job, you guys. Please email me if you have any questions.